Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. New record highs were set for the Dow, S&P 500, and NASDAQ. Gold rebounded, and Ross will also take a look at bonds, interest rates, oil, and Bitcoin. Author of The Money Bubble, John Rubino from dollarcollapse.com, tells us what could happen if there's a great economic reset. Are any assets worth holding on to, and can you beat gold in really bad times? InsideTrackTrading.com President Eric Hadik explores the cycles that could be playing a big role on how the markets are behaving and how major events keep happening around April 19th. Perhaps sunspots and lunar cycles could be a bigger factor than you think. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2 AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can also find him on Twitter at Charts by Ross. Welcome back to This Week in Money, Ross.
Always good to be with you, Jim.
Oh, it's starting to sound a little redundant, but more records set on the three major indices in New York.
Oh yes, the S&P had a fabulous week. The Dow was so-so, and the Nasdaq has been doing a lot of catch-up. We had that stretch there where the anything that was value was really coming to life in the early part of the year, and the Nasdaq was having its fair share of trouble. And about 2 weeks ago, we got extremes. We actually chart the ratio of the IWM, which is the Russell, versus the Qs, which is the Nasdaq, and we got good exhaustion figures on that one a couple of weeks ago. So it was time for a bit of a transition, and we're seeing that in big time. The Netflixes, the Amazons are really coming back to life here. Of note, this is April. This is the second best month of the year historically, and the market's doing what it normally does. You've had a little bit of a hiccup in March, and now getting this really good rally that started right at the tail end of the month there, probably around March the 30th. And we're starting to see some short-term overboughts, which is not surprising, but we're at that point where if we start to see a bit of an acceleration on the upside, and that is showing up right now in the S&P, if this continues much longer here, right into through next week, then we could be setting up for a decent correction. And, it's always, once you're in a trending fashion, you need to be watching where your supports are and where your resistance is. So S&P at this point, we closed off the week at about 41.28, and it probably gets a little pricey, maybe 10 to 15 points above here. The Dow's at 33,800, and I think anything just shy of 34,000 becomes an overhead resistance. If it were to break under 33,000, I'd be looking at that as the beginning of a pretty hefty correction. So, some ideas to keep in mind. And I guess one of the reasons that we've seen some of this buoyancy come back in was that, if you recall, back 3 or 4 weeks ago, all that anybody could talk about was the rising interest rates, how the 10-year yield on bonds was up around 1.65%, and, it come from 40 basis points this time, or in the last summer, and everybody was just talking inflation, etc. Well, at the middle of March, we got some numbers there on our readings that said the bonds were probably ready to consolidate, not go too much further, and that we'd probably look for 4 weeks or more of consolidation, which is what we're seeing at this point. So with that pause in the rates, that fear, the competitive fear with rates relative to the stock market, I think has allowed some of this buoyancy to happen. So for the bonds, we've got a piece of analysis we're putting out this weekend that would show that we're probably maybe going to give back 30 points or so as far as the interest rates are concerned on the 10-year. So probably get back into the 130s, having been up in the 160s. So there's probably some good trades, I think, available to anybody who's trading in the bond ETFs or the futures contracts.
What's going on with gold?
Another really good week, actually through Thursday, a really good week. Gave back some on Friday. But, we had been looking at the commitment of traders numbers the previous couple of weeks, and they were very positive. We had seen capitulation lows when gold was down around the 1685-ish range, and we had a big rally. We got up to, 1758 this week, so a nice rally, starting to see a little bit overbought. Same thing in silver, up to 2560, and looking for still some pretty big overhead resistance in the gold market, up in the 1780s, and in silver around 26. I'd be surprised if the metals can manage to push through those levels. I think they're a great level to be looking to sell into, and we're still of the mindset that a new low for the year could very well be coming as we move through the summer. So don't get too excited. I know a lot of people are talking about the double bottom in gold, but the patterns that we see, there are 3 or 4 of this style of pattern in the precious metals in the last 40 years, and each of them has difficulty making this turn. One more big cleanout could be enough to set the bottom in place, and then I think we're talking about substantial moves, but not until we've seen a deeper break than we've seen right now.
What's going on with crude?
Crude, same idea. Consolidation phase that we've been talking about for the last week or two. Closed off the week around just over 59.30. And the optimum here, when you've had a really persistent bull market like we've had now for, I guess it's, 11 months. It was April of last year when we had that minus number in crude oil. So if you look at the action since then, there was one correction along the way, but the trading ranges have been really tight within this uptrend that we've been having. And so a consistent move like that, we've got 8 of those if we go back from the 1990s to where we are now. And each one of them at the 10-month to 12-month period following from the low, you would see a good correction that comes back and tests the 20-week moving average. So at this point, that average sits a little bit below us here, around the just under $56, and I'd like to see it come down and test that probably in the second half of this month or into May. And what you would normally find coincident with that would be some nice oversold readings, and we'd be looking for the classic would be one of if we see a sequential 9 set up there as a buy setup, that would be 9 consecutive days with closes below 4 days earlier. That pattern really works nicely when you're plucking the lows within these rising trends. So looking for probably a really good opportunity before the next month is finished here.
Ross, what's going on in the cryptocurrency space, Bitcoin especially?
Bitcoin, we've been stuck at, I think we'll get to this 58,000, 59,000 level the better part of a month ago, and each little pullback has progressively found higher supports. And from what I can see, I think you're probably looking at something into the mid-60s initially, and we'll see what kind of correction happens after that. But the big pattern doesn't change. The depth of the big consolidation and that we've seen in the last 2.5 years still counts to 120,000, and I think that's a realistic long-term target.
Ross, thank you so much for the update.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. He's also on Twitter at Charts by Ross. Coming up, John Rubino, next on This Week in Money.
Always consult your investment professional before making any investment decision.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. He's speaking to us from Washington State near Port Angeles. Welcome back to the show, John.
Hey, Jim. Good to be back.
Are interest rates the big focus right now?
Yeah, interest rates are a really big deal right now because they've been rising lately because inflation is rising and the economy is starting to grow again. But, okay, here's a crucial thing that people have to understand about the way we've been running the global economy over the last 20 or 30 years. We've been responding to each crisis with lower and lower interest rates. And what sustained unnaturally low interest rates do is they, of course, encourage lots of people to borrow lots of money and spend it. But they embed all that debt at very low interest rates into the system, which makes us very vulnerable to rising interest rates. Because say you've got an adjustable rate mortgage or a prime plus one business loan, or you're a government that borrowed a bunch of money short term and have to roll it over, or any number of other kinds of people or governments or businesses that have variable rate debt. And when interest rates go up, that raises your cost of doing business or cost of living or cost of governing, to the extent in a lot of cases that it bankrupts you. So there's a point out there on, say, the 10-year Treasury note yield in the U.S. where a rate going above that destabilizes the financial system. And we don't know what that rate is, but we do know it's lower than it's been in the past because we've spent such a large number of years with extremely low interest rates that we're super fragile right now to higher interest rates. And the 10-year Treasury yield is rising lately in the U.S. It's gone from about 0.7% to 1.7%. So the question becomes, where does it become destabilizing? In other words, is it 2%? Is it 2.5%? Is it 3%? We just don't know that. But the current policy in the U.S. is to fight the effects of the pandemic lockdown with massive amounts of newly created currency just dumped into the system via stimulus checks and infrastructure building and all kinds of other things to stimulate the economy. And it's working. Lots of things are not just going up in price, but moving into the range of shortages where prices really spike. And that's industrial commodities. And of course, the stock market is way up and houses are way up. So we're seeing spreading pockets of inflation, dramatically higher inflation in the U.S., which is making interest rates go up. So we're creating conditions where we're at huge risk right now because if inflation jumps a little bit, which the Fed has said that it wants to happen and it will tolerate, and that pushes interest rates up. We don't know what interest rates will do in the 2 or 3% range, and they might cause an equities crash or serious turmoil in the bond market, or that might make mortgage interest rates go up and tank the housing bubble. We just don't know. But we're creating the conditions for us to find out. So interest rates are crucial for an understanding of the year ahead. So pay attention to whatever interest rate you normally look at and watch what it does.
Is this a conflicting message here from the Fed? On one hand, they're saying, oh, we're cool with inflation, but we don't want interest rates to go up, yet we know rising inflation brings up interest rates. How can you have it both ways?
You cannot have it both ways. That's the problem. And, the Fed is boxing itself into a corner where it's going to have at least two problems with mutually exclusive solutions. In other words, if the economy really starts rocking and inflation starts to go up, normally you would counter that with tighter money. In other words, you would raise interest rates in order to put a lid on price increases. But we can't raise interest rates without just tanking the economy. At least we might not be able to raise interest rates without tanking the economy. So the Fed possibly does not have any tools left to fight inflation, yet it's actively trying to generate inflation above its target range of 2%. And it's getting it. I think if we were honestly accounting for inflation right now, we'd be at 3 or 4 or 5%, somewhere in there. Instead, we're below 2% according to the official numbers, but those numbers are bogus for so many different reasons on so many different levels. And people are starting to realize it because the inflation is shifting from stuff like stocks and bonds, which people don't think of as inflation, and over to food and housing and cars and things that we buy day to day, where we can actually keep track of what the last thing cost. And now this one costs 30% more. Oh my God, that's the kind of thought process that's going to be going on out there. And it's possible that people react to that accordingly. They see they're in an inflationary environment and they start behaving the way people do in an inflationary environment, and that is very destabilizing. So we'll see. The rest of this year could be fascinating from a financial theory standpoint, because we're trying something really interesting with no real idea of how it's going to work out.
Does the stock market look like it's close to topping?
Yes, but I would have said that several other times during this massive bull market that we've been in. But stocks are as expensive as they've ever been, literally, in the U.S. I mean, this is as overvalued as 1929 and 1999, the previously iconic bubbles. But we're there again with big sections of the stock market. So just based on valuation, it ought to tank. But this whole rising interest rate thing is very possibly the pin that pops that bubble, because rising interest rates are generally not good for stocks, because stocks, to an extent, compete with bonds, right? If you're buying a stock portfolio where the dividends matter, you're comparing those dividends to what you would get in a risk-free, quote-unquote, portfolio of treasury bonds. And if the interest rate on treasury bonds goes up to a level that's higher than the dividend rate on stocks, what's the point of owning those stocks? You buy the treasury bonds and you dump stocks. And that could become a self-fulfilling prophecy here in the U.S., where it just turns into this massive bear market. We've seen variations of that in the last few years, so it could easily happen again, but this time on a much bigger scale in an environment where there's no tools left to fix it.
What's fueling the everything bubble, and could it continue to inflate?
Well, you have to go all the way back to 1971 to understand how we got here, when we broke the last remaining link between the world's major currencies and gold. And from that day forward, there was nothing stopping governments from just creating as much new currency as they wanted to. So we basically handed unlimited credit cards to emotional children, like politicians and the bureaucrats that are appointed by politicians, and they basically ran wild with it. So we've been creating more and more debt, which creates first of all, a financial bubble, and then a huge crash. And then we've been responding to that crash with ever lower interest rates and ever greater currency creation, which creates an even bigger bubble and an even bigger bust. And so the amplitudes of the booms and busts have been rising. Now we're at the point where we've really hit a wall. I think we're we're in a bust because of the pandemic lockdown and because of the boom that we were in prior to that, where the governments of the world have to bail out everybody in sight. So that means we've got to keep interest rates super low or push them much lower from here and run massive deficits in which we bail out state and local governments who let their pensions run wild and corporations who borrowed a bunch of money to buy back their stock and now can't, pay their payrolls. Subprime auto loans and student loans. It just goes on and on, all the things that have to be bailed out, with trillions and trillions and trillions of new dollars and euros and yen. So we're kind of at the end game. Now, can it go on for another cycle? I didn't think we could get through this last cycle. I thought 2009 would have been the end of the fiat currency fractional reserve banking world. So when I say probably we can't go through another cycle, you have to remember that I got the last one wrong. But my God, these numbers are just insane. So the idea that we're going to have another bust and then that we're going to print and spend our way out of it seems patently absurd to me. I think when this next bust comes, that's basically the end of this experiment. The monetary experiment that began in 1971, which is unique in human history, will have turned out not to work, and then we'll have to do something new. But the process of coming to that realization will be incredibly painful because it involves giving up huge amounts it involves giving up the power to create money out of thin air. Nobody would give up that power voluntarily, so it's going to have to be wrenched away from governments by some gigantic crisis in which giving up that power looks like the least bad alternative. So that's what's coming.
I asked our correspondent in Japan, James Corbett, how the Chinese government planned to deal with their massive debt, which was massive, horrendously big, long before this, and he says their plan is just to keep printing money. Is money printing key to keeping the bubbles growing?
Well, it has been in the past, but it's a strategy with a limited lifespan. You reach a point where you can't push interest rates down any further, and you can't buy back any more government debt without it being destabilizing, and you can't dump any more money into the stock market without valuations going to insane levels and real estate. You get inflation at a certain point that is uncontrollable. And I think we're heading there. I think that it could be in the next few years that this happens. And that's the end of the game.
If the everything bubble bursts, will there be any safe places to put your money?
Very few. Very few financial assets will do well in the bursting of the everything bubble. In other words, don't own a bunch of government bonds in a system where some kind of huge currency reset that lowers the value of the currency has to happen because that lowers the value of your bonds. Don't own bank stocks. Don't own investment bank stocks. Don't own home builder stocks. Things that depend on financing, get out of. Get into real stuff like a rental house, some farmland, gold and silver, maybe some energy assets. Those things can't be inflated away by a crazed, panicked government. So they'll tend to do better. So yeah, there'll be places to hide out, but they won't be the usual places that you think of as risk-free, like a bank account or a bond fund. You need to go all the way over to physical assets like precious metals to find a true hiding place when everything hits the fan here.
Do you think the Great Reset and Agenda 2030 will take hold, and maybe explain what those are? And where their philosophy, I believe, is you will own nothing and apparently be happy about it.
Complex subject. First of all, there are two resets out there right now. There's a currency reset that people like Jim Rickards talk about and that whose ideas I steal for some of the stuff I say. And that's when governments decide that they just can't manage the current monetary system and then they just reset it to a hopefully sustainable way of being. All right, that's one thing. Now, the other thing you're talking about is the plan that the elites of the world apparently have to reset the entire global economy using high-tech and presumably authoritarian government policies. And yeah, they say some wild things that sound wild to people. And, frankly, I like a lot of the stuff they're talking about. Lower birth rates to stop population growth and start the human population shrinking. I love because there's way too many people. We're ruining the world with our 8 billion people. 1 billion would be a much better number. The idea, like you said, that you won't own a lot of stuff, but you'll rent things and you'll be happy to do it, is also something that technology is bringing about. I mean, the whole sharing economy. Like, if you live in a city, you don't need a car. You just take Ubers wherever you go. You rent a car for a half hour or whatever. I could see that extending to lots of different parts of my life. For instance, I own a chainsaw that I use once every 3 months for, half a day, let's say. I'm being optimistic there. It's usually not a whole half day. But it would be easier for me if I just, pulled up an app on my phone, had somebody deliver me a chainsaw once every 3 months. I use it for a few hours, and they come pick it up and take it away. It would be cheaper and easier, and they would maintain the chainsaw, and I wouldn't have to. So extend that to many other aspects of life, and it's okay. And then there's Bill Gates saying we're going to eat synthetic beef, which is also an interesting idea. If we can grow just the meat and not have to grow the bones and the hooves and the horns and everything of these animals, and the animals don't have to suffer, but the meat we grow is chemically and nutritionally identical to traditional factory animal farming, I think that's a good thing too. But these things are only good if they happen via market forces and the personal choice of the people within the markets. If they happen as part of a top-down dictatorship kind of thing where it's imposed on everybody whether we like the idea or not, then it's emphatically not a good thing. So that's what worries me about the whole Davos Great Reset thing, is that they seem to have the idea that instead of just letting these new technologies come along and letting us as free individuals choose them, that they're going to impose them on us. And I don't like that idea at all. I think that's a recipe for, a dictatorship. It's almost a textbook dictatorship. So hopefully market forces do the job, and the elites don't feel like they have to jump in and get involved here. So we will see.
Here in Canada, we have massive carbon taxes being imposed on us. And if you fill up your family car or your minivan to haul the family around, in just a few years, you'll be paying $72, $75 more to gas up. Is that the right thing to do? Or is that what you're worried about?
Well, see, that's an example of a technological revolution that's happening mostly via the market. Because in 3 or 4 years, you won't be gassing up. You will be charging your car battery and driving your electric car around. That brings other environmental and technical challenges with it. But assuming those technologies work at scale, then that solves the fossil fuels problem, at least the oil problem. We just won't need coal. Well, we won't need oil anymore to drive our cars. We will need electricity. So then it becomes a question of where do we get our electricity? And, if we can get it via, for instance, solar power, which the jury's still out, but it's looking promising because solar gets cheaper year after year after year, then new technologies have come along and taken care of this transition without the government having to force us to do it. So right now, governments feel like they have to engineer or turbocharge this process. But I actually don't think they have to, because something like solar power gets cheaper by 5 or 10% a year. You just extrapolate that into just another decade, and you get energy that is so much cheaper than coal that nobody in their right mind would ever build a coal-fired power plant again. And electric cars, same thing. As batteries get cheaper and cheaper, it becomes patently absurd to drive or to power a car with oil, an oil derivative. So I think that all works out, but it's not clear if it's going to work out quickly enough to satisfy the would-be one-world government dictatorship that is growing out there. So we'll just have to see. I really don't know how this plays out.
We'll have more with John Rubino right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Rubino. John, what do you see ahead for gold?
Well, gold is basically right now doing what it's supposed to do. It's protecting people's purchasing power by going up over intermediate to long periods of time in local currencies. Gold was $250 US at the beginning of the century. Now it's $1,700 and some dollars. So it has protected you against the depreciation of the dollar. I think going forward, the future is spectacularly bright for gold and silver because we're making all the mistakes that you and I already talked about today. And we're accelerating those mistakes. We're not pulling back from them in any meaningful way. So the big danger for gold and silver short term is that interest rates spike and gold tanks scenario. And stocks tank. And they pull down gold and silver because everybody's terrified and they're selling everything they've got, and so you get a kind of a V-bottom thing where gold and silver tank, but then they spring right back to life when everybody realizes that with stocks tanking, our only chance of survival is to depreciate the dollar even more quickly. And I think there's a good possibility of it playing out that way so that we might have to eat some losses in the short run, but we'll also have some nice buying opportunities. But in the intermediate and longer term, gold and silver will behave spectacularly well. In other words, I'll make some price predictions without timing predictions. But so in the rest of the cycle as it plays out, gold hits $10,000 US per ounce and silver hits $200 US per ounce. And I think those are very conservative numbers and very easily achieved, especially in the case of silver. And if that happens, we'll forget about that little V-bottom crash that we had to live through to get to, precious metals nirvana further down the road. And I really do think that's happening.
Has Bitcoin turned into the new gold and silver?
Bitcoin, we still don't know what Bitcoin is yet because it's brand new. It hasn't been through any big cycles or, financial cycles or anything yet. And it's behaving right now like a tech stock circa 1999. In other words, it's a bright, shiny object that everybody wants to be in and huge amounts of money are pouring in. But a lot has to happen from here to long-term stability as a monetary asset for Bitcoin. And one thing that has to happen is that the governments of the world have to strike out at it because it's now becoming a threat. And, no central banker in his right mind is going to let some, piece of technology come along and take away his ability to create money out of thin air. They're just not going to let that happen. So they're going to try to either regulate Bitcoin really aggressively or flat out ban it. And then the question becomes, can governments do that? And there are a lot of people who say, no, it's over. That Bitcoin has reached its tentacles too far into the mainstream financial system. You have corporations buying it, and it won't be long before central banks will be adding it as a reserve asset, and you just can't stop it. Maybe that's true. We will see. But I think they're going to try, and I think that it's going to be a fascinating thing to watch, and I have not the slightest idea how it plays out. But I think that's the hurdle that Bitcoin has to get over. In other words, it has to face a backlash from the world's major governments and survive it and come out stronger at the other end. Before it's going to be something that we can point to and say, oh, okay, that's what Bitcoin is. I get it now. I see how it fits into the global monetary system, and I see what it is in relation to older forms of money. Then we'll know all that. But right now we don't know any of these things. Everything's just kind of evolving in a really fascinating way.
Why are some NBA franchises offering to pay their players in Bitcoin?
Because it's becoming accepted in the mainstream. See, it's a thing that a lot of people are latching onto as an idea. And so everybody's feeling some pressure to address that. You're seeing PayPal allow payments to be made in Bitcoin. and some other bank-type entities doing the same thing. You're seeing, you can buy a Tesla with Bitcoin now, and apparently you can get paid in Bitcoin if you're an athlete in some places in some ways. So this stuff is starting to happen. And the problem is that has now got the attention of the major governments. So they're going to see this as a threat, and they're going to lash out at it. And then we'll find out how all this goes. But right now, it's a very interesting experiment in private sector technology-based money as the next big thing. But Jim, I don't know if you were going to ask any questions about Bitcoin relative to gold, but I think that's one thing that we should address here, because they're not the same thing at all. Gold is a physical thing, and Bitcoin literally does not have a physical existence. So in the kind of thing that if you're a prepper, you do have to prep for, like an EMP attack or a natural disaster that knocks out the grid or a cyber attack that takes down the internet, you need physical money for that kind of a situation. And that's what physical gold and silver are for. They're not for traveling across national borders with a suitcase full of silver or anything like that. That's not what you want. You want physical gold and silver on hand to be able to transact and preserve wealth in a Mad Max shit hits the fan kind of scenario. Now, Bitcoin is something that, because it doesn't have a physical existence, you can instantly move it from one place to another. And that has huge advantages too. So these things aren't really direct competitors, but they're, in actuality, they may be complementary assets as a way of moving money around the world and protecting yourself in the physical moment against really extreme circumstances. So I think, when we see what Bitcoin becomes, then maybe everybody should own some Bitcoin. And right now we know what gold and silver are, and everybody should definitely own some gold and silver. You shouldn't think of them as competitors. You should think of them as complementary ways of protecting yourself from the various things that could go wrong out there.
Yeah, like you can wear a helmet and steel-toed boots at the same time.
Exactly, and strap a 9mm Glock on your belt, and do a few other things. You want to take care of all of these possibilities with the proper tool, and the potential crises out there are multiplying. We saw in Texas, I don't know if you in Canada you were paying much attention to that, but Texas is sort of our successful state. But they had a winter storm that knocked out their power grid for weeks in some cases for some people in the middle of winter. It was cold down in Texas, and there was no electricity. So anything can happen. Lots of bad things can happen, and the power grid is at risk, and the internet is at risk, and the banking system is at risk. So we want to make sure that we address all those various potential problems as part of our financial and physical prepping. You want to have some food on hand, you want to have some gold and silver, all of that stuff, against these increasingly conceivable, horrible things happening. So there is no one single tool that does everything. But there are lots of tools that address one part of these different crises. So the intellectual challenge is to combine them all in a coherent way that you can manage and that protects you from as much of the crazy stuff out there in the world possibly happening as you can manage.
Could the cryptos end up being the modern day version of tulips?
Maybe. See, like I said, we don't completely know what Bitcoin and the other cryptos are yet. And one of the threats to Bitcoins and cryptos in general is technological. What if one comes along that does the job better than the existing crop of cryptos? So will we look back on them and think, oh my God, Bitcoin was $60,000 at one point, and now it doesn't even exist anymore because everybody uses this new coin. That's a completely feasible, possible scenario because we just haven't figured out whether these things are bulletproof from the point of view of technological change, or whether, for instance, in Bitcoin's case, whether the network gets big enough that you have network effects that are effectively a moat around Bitcoin that protect them from any new crypto coming along and doing a better job. We'll see. There are people who say that that's the case. I wouldn't pretend to have an idea about whether that's true or not, but there are some very smart people saying it's true. So we'll just have to see. It could be that we look back on these charts that have been straight up for the last, well, not straight up, but in the intermediate to longer term, spectacularly straight up, and we look back on them, and the last part of the chart is straight down to zero. It could be. We just don't know. So don't, the people who claim to understand Bitcoin well enough to put their life savings into it, it could be that they're right. But I think the average person, and I'm including myself in this, doesn't have the technical understanding of cryptos and tomorrow's cryptos to make that kind of a decision. So by all means, own some Bitcoin, because if you want to shift some money out of the country, it's a really good way to do that. But don't bet the farm on it, just like you wouldn't put all your money into farmland only and nothing else. You just don't want to do that. So diversify. You can include cryptos in your diversification, but do not think of them as the only viable asset 10 years from now, because that probably won't be the case.
Is the real estate market in a bubble?
Oh, yeah. It is in the U.S. now. It's a different kind of bubble because it doesn't have the absolute crazy behavior that the 2005, 2006, 2007 bubble had here. But it does have prices spiking at the same rate that they spiked back then, houses coming onto the market and getting 15 or 20 or 30 all-cash offers on the day it goes on the market. That kind of thing that happened back then is happening again now. So it has elements of a bubble, which means there are air pockets under house prices. And to the extent that people are buying as much house as they can because they assume it's always going to go up, I think they will find out that that's a mistake this time around, just like last time, because, again, interest rates are a threat here. Most houses are only affordable to most people because mortgage rates are super low. But let the yield on that 10-year Treasury bond go up from here. That'll pull up mortgage rates, and then we'll hit a point where virtually nobody can afford the average house in their neighborhood, and then the process stops. People can't buy the houses because they can't afford the houses. Therefore, no houses get sold. Therefore, the market tanks and prices go down. That's going to happen, very probably out there somewhere. This house bubble will go the way of all bubbles, and it'll burst, and then normality will resume at some level at some time.
Will it make a big difference to this bubble once the pandemic is over and people start heading back to the office and maybe find out that maybe living in a small apartment near work is better than being 50, 60, or 200 miles away and having to come into the office and do that commute?
It might. The pandemic changed a lot of things. It allowed a lot of companies to figure out exactly how much remote work they could handle, and it turned out to be quite a bit. So I think a lot of the remote work thing is here to stay, just because it turned out to be technologically doable, and it's way cheaper than paying high-priced downtown office rents, right? So that part is probably going to happen, but we don't know to what extent it's going to happen. And we don't know how many people will be pulled back into their downtown offices and how many won't. And we don't know how that's going to affect real estate prices going forward. So we'll just have to see. But the undeniable fact is that houses in the U.S. in a lot of places are unaffordable for most of the people that might buy them or might like to buy them. And you can't go too far from the point of extreme unaffordability in the housing market because there's just literally nobody left to buy the houses unless Wall Street private equity companies start coming in and buying up houses to convert them to rentals. But if they do that at this level, they're buying a bubble asset. They came in last time in 2009, 2010, bought up houses all over the country, but they bought them from banks who had foreclosed on them at ridiculously low prices. So it would be a surprise to see Wall Street coming in a big way now with prices that are maybe quadruple what they paid for the same house in 2009, let's say. So I don't know. I don't think the home price bubble can inflate much further just because who's going to buy the houses? There just isn't anybody left.
How is the car and truck market doing?
That's an interesting story because we've had a car boom in the U.S. in this cycle. And we've also, part of the thing driving it was subprime car mortgages, car loans that go for like 8 years and have high interest rates and are written to people with bad credit. That was the booming part of the car finance market for most of the last few years, and that allowed car makers to sell a lot more cars than they would have otherwise. But then the pandemic kind of crushed the subprime part of that market because those are the people, subprime borrowers are the people who work in restaurants and the bars and bricks and mortar retail, so they lost their jobs. So now there's a spiking trend in late payments in subprime car loans, which means we'll have a bunch of defaults coming pretty soon. So you would think that would hit the car market pretty hard. But instead, car sales are still booming. And what I think is happening is that there's a segment of the market that's been hit hard by the pandemic and another segment that's actually doing really well. The people who work online or who got to remotely work for their company and they're living far out of the city and paying less to do it and they're getting stimmy checks from the government or maybe they don't have to pay rent because they're getting rent forbearance, so they have a lot of extra money, so they're out there buying cars. So car sales are booming, which makes no sense. The pandemic should have crushed discretionary large purchases, right? But it didn't, because the government just gave everybody so much money. So who knows where this goes, because now cars are kind of a bubble. Or at least they're an inflationary asset, because the price of cars are going up, the price of used cars are rising, and people are still buying them. So that's another thing that's pushing the consumer price index up, another thing that will then contribute to higher interest rates because of higher inflation, and that will contain the seeds of its own demise when interest rates get so high that it chokes off borrowing out there. So all of these things have an endpoint in sight, and it's all associated with a 3% yield on the 10-year Treasury.
Do resource juniors tend to go parabolic towards the end of a bull market?
Yes. And that time is still coming here. Right now, here's the dynamic in the gold and silver market. The big miners, even at today's prices, even though we've had a little bit of a correction, they're still making a lot of money and generating a lot of free cash flow with gold at, say, $1,700 an ounce U.S. And so far, they've been very wise with their extra money. They've paid off debt in the aggregate, and they're raising their dividends, which makes their stock much more attractive to people looking for yield out there. But as this goes on, as gold and silver continue to rise, and these big miners continue to make massive amounts of free cash flow on what they're selling, that money's going to start to burn a hole in their pockets. And they're going to look around for companies they can buy, miners they can buy, that will move the needle on their resources. In other words, that will immediately let them produce a lot more gold and silver. So they'll start buying up the highest quality juniors out there. Then, people who weren't paying attention before will see all this activity and see the prices of the juniors that are being bought out go up, and they'll say, okay, who's next? And all this momentum-based outside money will pour into the junior mining sector and send prices up parabolically, just straight up for a couple of years. Anything with junior gold and silver in its description will be like a .com in the 1990s. At which point, we want to start selling our junior mining stocks to the new people with hot money who are coming into the market and cashing out. That day is not yet, but it's not that far away, because even right now, the big miners are stockpiling cash. So even if gold and silver don't go up from here, we still get that dynamic in the junior mining sector at some point in the future. But if gold and silver go up, which they should, then you get a double whammy where there's already plenty of free cash coming in, and then gold and silver go up, and it doubles the amount of free cash coming in, and then boom, all hell breaks loose in this market, and that day is coming in the not too distant future.
What are the latest concerns when it comes to geopolitics?
Okay. We're not behaving well around the world. We've got the U.S. and NATO trying to steal Ukraine away from Russia's sphere of interest, sphere of influence, by talking into joining NATO. Russia doesn't like that one bit because Ukraine has a naval base that is Russia's only blue water port, one that doesn't freeze at some point during the year. So they want that naval base, and they're not going to give it up. And so they're moving tanks to the Ukrainian border, and we're over there stirring up trouble, which is incredibly stupid for nuclear powers, right? But we're doing it. Meanwhile, over in China is threatening Taiwan that for some reason the U.S. thinks it's obligated to protect. I don't know why that is. Why, would we fight a nuclear war over Taiwan? I hope not. I absolutely don't think we would, but I hope the guys in charge also don't think we would. But they're kind of bumping up against each other over there too, with China invading Taiwan's airspace and sending ships through the South China Sea, and the U.S. sending other ships through the South China Sea. This is really dangerous stuff. And hopefully we don't let it go any farther than saber rattling, but you never know with these people. These are not super geniuses in charge of geopolitics in the U.S. right now, at least. I have no idea about the level of understanding or the character of the people in China and Russia, but it's pretty clear that in the U.S. we've just got a bunch of chicken hawk psychopaths running things, and who think that because we used to be the most powerful country in the world by far, now that we're one of several extremely powerful countries, we can still behave the way we behaved back when we were the global superpower. I think they're going to find out that it's not as easy now with Russia and China as emerging powers as it was after World War II, when we could push people around for most of the time. So we'll see. And hopefully it doesn't turn into anything, but if it does, all the other stuff we talked about up to now, forget about it. All bets are off. There is no way to predict what happens in the world. And you will be very glad you have some farmland and some gold and silver in that circumstance.
Well, China's already proved that it's willing to use microwave weapons in a conflict. When they were arguing over who owned a mountain in the Himalayas, they chased the Indian troops off by microwaving them. So that's the warfare of the future. Are you prepared to be microwaved to death?
We have all these weapons that have never really been used in a major conflict, and we don't have the slightest idea what artificial intelligence-driven nuclear-powered drones will do, or battlefield robots, or hypersonic missiles, or EMP attacks, or cyber attacks. We don't know what any of this will do, except that it will complicate things. So chaos is probably the only certainty in next-generation warfare, because we really just have never tested these things out. We do not know what they will do when they go up against other teams' variations of them. So hopefully we never find out. In an ideal world, everybody would just look at the stuff we're developing and say, we can never use this stuff on a planet, Let's go out into space if we want to try these things out. But on Earth, let's stick to tanks and planes and stuff. Who knows if they're that wise? I suspect they're not, but we'll see.
John, how can people find out more about dollarcollapse.com?
Yeah, well, just stop over anytime. The site is updated all the time, and it covers a lot of the stuff we talked about. And we're also on social media at MeWe and Minds, which are social media platforms that don't censor too much and don't spy on their people or anything. So they're nice alternatives to Facebook and Twitter and things like that. So stop over there. Join our page, join our group, and we'll watch all this stuff from a safe distance.
John, thank you so much for being on This Week in Money.
Thanks, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. He was speaking to us from Washington State near beautiful Port Angeles. Coming up, Eric Hadik, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Eric Hadik, CEO and President of InsideTrackTrading.com. He's speaking to us from the Chicago area. Welcome back to This Week in Money, Eric.
Oh, thanks for having me back, Jim.
Eric, for newcomers to InsideTrackTrading.com, can you explain what the company's all about?
We are a technical and cyclical analysis advisory service providing different monthly and weekly publications, as well as a lot of educational material, tutorials, special reports, and other types of informational material on the markets. Ever since the start of the company over 25 years ago, my objective has been to educate as well as inform and intrigue readers, and trying to just tie all that together so that any reader comes away with hopefully not just some valuable information, but also some educational material that's going to help them whether or not they stick with our publications.
Eric, cycles are important for your work. Does the first day of spring mean anything to us when it comes to the financial markets?
I have long discussed the viewing the markets in terms of the natural year. And I define that simply as a agricultural, solar, nature-based year that starts with the vernal equinox and obviously would end with the day before the vernal equinox on the ensuing year. And when it comes to commodity markets and more natural-based type of things, even your energy markets and stuff like that, there has often been a strong correlation to movement, and especially in the start of spring. But I've also seen it in the financial markets. And one of the things that I really focus on, not just that day, although in 2020 you had a perfect example of it. I described in late 2019, early 2020 how not only was I looking at that point in late March of 2020 as being an annual cycle, but there were a lot of longer-term cycles pointing to the same thing. And lo and behold, in late 2019, early 2020, you got the signs that a new solar cycle had begun, an 11-year sunspot solar storm cycle. And so it was types of beginnings on multiple levels. And as we got very close to that March 20th, 21st date, several markets were showing that they were ready to, just as the Earth does in the northern hemisphere, come back to life surrounding that date. And that turned out to be the silver market and all the precious metals bottomed on the days just before the vernal equinox. Most stock indexes bottomed between March 18th and March 23rd of last year. Some other markets, it took a couple more weeks, but that was when these markets, just like the Earth, kind of came back to life. And so I do definitely watch that in terms of financial markets as well. And I kind of break it down in a little bit like we do with a calendar year. And to me, the real pivotal time is that first month of the natural year. And, I guess on a, from a astrological perspective, you'd think of it in these ways too. But from the vernal equinox until April 19th, April 20th, that first month of the new year, you get a lot of very significant moves. But even more important, you get some very strong indications of what to expect for the remainder of that new natural year. And so if you get a market that, like with stocks and precious metals last year, if it has not only bottomed but starts to trend upward during that period of time, and then once you're beyond that period of time, once you're beyond April 19th, 20th, those markets exceed the highs that they set during that opening range, that's a very strong trend indication for the 11 months that follow. And there's a lot of rules and guidelines that apply to that. It's not as simple and straightforward as what I'm describing, but I'm just trying to give a general idea. And the whole thing comes down to where that first 30 days of the natural year is so critical, and it has been in societies, in nations, in empires, going back for thousands and thousands of years. And you can open up the Old Testament and the Bible, and you can read multiple accounts where a phrase like in the beginning of spring when kings went off to war, and you can see that it's right in that time frame as soon as kind of Earth's coming back to life in the northern hemisphere. And that even flowed through to the Roman Empire and the celebration that they called Tubilestrium, if I'm pronouncing it correct. But it all had to do with the god of war and sacrifice being made, and even your celebration of Passover and Easter usually occur during that time, which also have their own application to sacrifice and rebirth and things related to that. So it's a theme, and it's a principle that flows through our entire world and also flows through to the markets. But not only do you have that first 30 days, that opening range of the new natural year, but I look at the days immediately surrounding April 19th, the culmination of that 30-day period, as being just extremely significant, because it does, to me, it's giving you an indication of what to expect from that point forward. And so many times in the past, there have been significant military, or in more recent decades, different types of attacks that might be terror-related, that occur right around that time frame surrounding April 19th. And so once again, that period leading up to it, that whole 30-day period between the vernal equinox and April 19th, has a lot of significance in the markets. And even this year, from technical and psychoanalysis, that's completely distinct from that. So it's a corroborating factor. A lot of my work showed that stock indices and overall stock market was set for another rally from late March into April 15th, 16th. And in fact, the 16th is kind of the final trading day before the 19th. That's a Friday and a Monday. Gold market and precious metals and the XAU index were all showing similar things. They triggered buy signals at the end of March, and were showing that they should rally up into about April 16th to 19th. So there's a lot of independent analysis that I have that's pointing to the significance of that time frame again this year in 2021.
Eric, for Canadians and British Columbians, it's interesting those dates have been brought up. On April 19th, it'll be the Canadian federal budget, the first in more than 2 years. And on the 20th, it's the British Columbia budget. So you're bang on. Significant financial things.
Me, and I don't try, sometimes when I mention different things, I don't have much control on over how people are going to take it and maybe embellish it or exaggerate it. But I'm
sure when they set those dates, they had no idea you would say that.
Well, and so, no, but the point I'm getting at, I'm prefacing something here, is it's been very intriguing to me, what really has been the focus of the last year, and particularly the last couple months, has been COVID and ultimately vaccinations, and here in America it's something that's, still pretty controversial between different political extremes. And so what do we have the last couple of days is President Biden going out and saying, okay, I'm expediting the time frame. Every American will now be eligible to get the vaccine on what day do you think he picked? April 19th. And again, I'm not, saying that that's any dramatic thing. Again, people sometimes like to take one or two things and then tie a whole wealth of significance to it. To me, it was just more of that's funny, and see where that takes us. But if you do, when I first started kind of studying this date and writing on it back in the 1990s, it started out with a focus on America, and it's very intriguing to me how significant that April 19th time frame and the days immediately surrounding it have been in America since the Revolutionary War. I mean, April 19th, 1775 was the first shot of the Revolutionary War. You jump ahead 100 plus years, or not quite 100 years, 85 years, and the first bloodshed, in the Civil War, was on April 19th, 1861. In between that, you had, within a couple days of that, in 1836, the end of the Texas Revolution and independence of Texas occurred a day after that, April 20th, 21st of 1836. The trigger for the first shot of the Mexican-American War was right around that date in 1846. The Spanish-American War, the resolution that was passed by Congress and President McKinley, was April 19th, 20th of 1898. When you go into the last century, really, if you look at one of the critical turning points in World War II, as far as the Americans and the Japanese, it was April 18th, 1942, the Doolittle raid on Japan, which was originally scheduled to go on the 19th. And, you just keep, April 19th, 1961 was when the Bay of Pigs invasion failed, in Cuba. April 21st through the 30th, really, it's kind of a little bit of a multi-day period there. 1975 was the fall of Saigon and the end of the Vietnam War. And so it's just over and over. So then as we came into the 1990s, and like I said, this is what really kind of piqued my interest and had me researching it more, then you started getting a new form of battle, of attack, of war, if you want to call it that, when you had things like the Waco Branch Davidian affair in Texas, and the Columbine shooting, and the Oklahoma City bombing, all right on or within a day or two of that April 19th date. And you went into the 2000s, and there were there were more attacks, and I think it was the Virginia Tech shooting, and there's just a wealth of them. So it just reinforces that time frame has some significance, whether we can identify exactly what it is, but it's a recurring, challenging time frame, and the markets often corroborate that, go along with that, particularly a market like gold, where it's sometimes a precursor to tensions or challenges in the world around us, and sometimes it's a reactionary force from events that have surprised the markets, and so that's one of those things. And like I said, my work triggered some buy signals in gold in late March, and the first, I think the advance is going to last a couple months, but the first surge I expect to go from that March 30th, 31st date into April 16th or the 19th. So then I ask myself, okay, is it possible that any fundamental event would coincide with the culmination of that? Because often you get a move already happening in the markets, but a corresponding fundamental event won't happen until well into that move, and sometimes it happens at the very end of the trend because it's what gives you a big spike up, and then that's where things settle down for a bit. So gold is one that I often watch related to that, and even a couple of years ago, it was very intriguing to me. I've documented just some of the move over the last decade of America's dominance in the financial and economic markets and the challenges against that compared with China's developing and increasing influence in those realms. And 5 years ago, when China was ready to launch their own gold exchange and start getting into that aspect of financial economic power, they did it on April 19th of 2016, the Shanghai Gold Exchange. So there's a lot of connection with gold, with some financial markets. So it's a whole, more of a holistic view of the markets and of nature and these sometimes annual cycles that are very intriguing with what they bring about in the markets.
Does this mean that we're going to see a peak in the markets around those dates?
Let me break it down now to more specific analysis. When you're talking about stocks and the stock market, I have been looking for since last March when equity markets showed that they were bottoming, my focus turned to the second quarter of 2021 when I thought we would see the next significant peak in stock market. One of the reasons for that was this very consistent 16-month cycle that has evolved in stocks, and it last peaked in January and February of 2020. And the ensuing cycle is looking for a peak in May or June of 2021. There's a intervening 8-month cycle that has also been very consistent, also focusing on that same May-June time frame. As we got closer to, as we entered the year of 2021, and I was looking at more specific weekly cycles, daily cycles, other timing indicators that you wouldn't necessarily classify as cycles, but are more objective in my work. And the picture that started to form was one where I thought we would get an initial surge into mid-April, and then some sort of pullback or consolidation phase, and then probably another upthrust into June of this year. And there could be some divergence there too, where certain stocks and indexes are making new highs in June, while others are making lower highs, and it does turn out that mid-April was their ultimate peak. So that's kind of the scenario that I've been looking at, and price action has been corroborating that over the last couple of weeks. There's been some very specific upside targets in indexes like the NASDAQ 100, the S&P, Dow, several other indexes that I've published for my readers. And it's starting to look more and more like the attainment of those price targets will likely coincide with the cycle expectations, which that's really the ideal scenario, is that a market is hitting your price targets at the same time the cycles are converging. So I do think that we're going to see a significant peak in equity markets right around mid-April, but that doesn't necessarily mean it's a final peak. It certainly should hold for a few weeks, and then the price action coming off of that peak will be the strongest indication of what to expect in the weeks and months that follow that.
With all the stimulus money being shoveled out of government coffers, does that affect how the cycles react to things that are going on? Or does it change them or change expectations? Or are these cycles the same no matter what the government or other bodies do?
Well, as I was just saying, a lot of times fundamental factors occur in the middle of a trend or in the middle of two cycle extremes and act as corroborating, sometimes accelerating factors. They may intensify the move, magnify it, maybe stretch markets farther in a price, from a price perspective. But the timing and the cycles still seem to adhere pretty closely to what they had done all along. Who would have thought? I mean, in 2019, I kept talking about, I had multiple reports and monthly publications talking about early 2020 as being a recurring, what did I call it? The stock panic cycles and global shaping events. I think that was, sometimes I've written so much that these little nuances of it I get lost on. But and so I kept talking about that happening in the first quarter of 2020, and throughout the third quarter and fourth quarter of 2019, kept describing this 16-month cycle in stock market that was calling for a very significant peak between mid-January and mid-February of 2020, and even went so far as to project a 20% or more sell-off following that. Well, those cycles didn't know that COVID was suddenly going to take hold in first quarter and then appear to decimate the economy, and have the stock market react and or overreact the way it did between mid-February and March 20th. But so that fundamental factor came up right where it cyclically needed to, and all it did was magnify and reinforce and highlight those cycles. So something like stimulus spending, to me, it just is a reinforcing factor most of the time.
When it comes to the metals markets, is it going to, or are they going to follow the same kind of pattern as the stock market?
I think that they are more likely to start diverging in the period between probably late April and August, September of this year. And one of the reasons that I'm considering that, suspecting that, is that my work in stocks and metals and many commodities for the majority of this time frame from last March of 2020 into where we are now, the second quarter of 2021, those markets have moved pretty close in lockstep. Not necessarily day to day, but the trends have been definitively up in metals, in many commodities, in stocks. And you see the obvious reasons for that. When we had that reaction in February, March of last year, and everything looked so deflationary and depressionary, then commodities coming back and a certain amount of inflation was viewed as a very positive thing. You know, it always just kept showing that there were hints of recovery and hints of progress and economic increased activity. And so stocks and those inflationary markets move together during that time. But you often get factors like that are the inflation that the price inflation that I'm referring to, where they're a positive thing for stocks for 95% of a cycle. And then during the last 5%, all of a sudden, it's like they crossed the Rubicon or they hit a tipping point, and all of a sudden, those inflationary factors now start to trigger a different reaction. And you've seen a couple little hints of what that might be, where you get interest rates starting to just nudge up a little bit in longer-term rates, and you get other factors that are starting to respond a little bit to this inflationary move. And at some point, it's likely, particularly if you did get gold and silver, or maybe a couple other markets, having a little bit of an accelerated rally here, where all of a sudden you could see a divergence, where then stock traders start to look at it and say, oh, wait a minute. Now we've gotten a little too frothy or a little too inflationary, and stocks react to that. So getting back to my precious metals analysis, what I've been looking for there is a very significant, at least intermediate peak in May of 2021, but there's just as many and just as strong of a cyclic argument for another peak in August, September of this year. So it wouldn't surprise me to see something where, you know, stocks peak here in mid-April, gold initially peaks with it, but then maybe in early May or something you get an additional trigger that pushes gold and silver up to the next level. And maybe it doesn't have quite the same effect on stocks. You start to get different fundamentals that are more individual, more isolated as far as hitting specific markets, not the whole gamut of financial markets. And so maybe we see precious metals move up into the more specific dates that I have in May, and if they were able to come back off and stocks make that final move up into June, and then metals make another move up into August, September, you could have a kind of a vacillating that begins to happen during this time frame, and it may be because other factors are starting to drive that movement in the markets.
Something that is relatively new, and I wonder, is it affected by cycles, and that's cryptocurrencies like Bitcoin?
I think they definitely are, but when you're looking at, say, intermediate, weekly, monthly type of cycles that I put a lot of emphasis on, there's such a short data history to base that on, and a lot of technical analysis and cyclical analysis has to do with synergy, with mass psychology, and you can't really measure longer-term cycles of mass psychology when all you have is a few years of data. So from that perspective, I do look at it from the broad perspective of currency and dollar and fiat currency versus hard currency, those type of cycles, and now digital currency entering that debate, that battle between currency supremacy of some form. And so I partially link it to dollar cycles, but also kind of a dollar versus precious metals. And Bitcoin has shown some, has adhered to some weekly cycles. Most recently, I was looking for a rally back to its highs during the final day of March or first day of April, and Bitcoin rallied right back up to its recent highs. I think it's at its highest daily close, at least on the Bitcoin futures that I also watch, and showed some adherence to daily cycles, and I have seen that multiple times. I just definitely take it with a grain of salt because there's not as much historical data, and therefore it doesn't give me quite as strong of a confidence level in it.
Eric, any other cycles that we should be keeping a close eye on right now?
I think that's probably a good amount of things to focus on right now, so I think that's probably a great place to wrap things up.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com, Inside spelled INSIIDE. He was speaking to us from the Chicago area. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Eric Hadik. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to Company Showcase, Larry.
Well, Jim, it's always a pleasure. We certainly put a press release out this morning on our manganese project on the Wendon stockpile. It is being paid for by the U.S. Defense Logistics Agency. And we're making good progress. We think that we'll give them a more than satisfactory response on our work. It will be finished up in another, I don't know, it was a 37-week program, so it's probably halfway done. And that certainly makes us happy. The results have been good. It looks like there could be some changes in the flow sheet that would maximize, different aspects. Major one being the cost of operation, and the other one is our extraction and the rates, which are 99%. We haven't done the purity rates yet, but that'll be in a future press release. But that's very happy stuff, Jim. But the major thing is that we've been under a attack for a few weeks now, and just looking at the market today, we were trading at 124 to 125. We ended up at the very end of the day at 121 with a small bid and a big offer at 122. And that's been reoccurring every day. And I'd have to tell you that investors don't wait till the end of the day to get the lowest price and smack the bids. That's predator trading for you. Press release, they wanted to make it look like it was weak, and that is not the case. That was a great press release, and we should have gained some traction on that. But, the last time their foot just slipped off the spring, we bounced up with the help
of the Robin Hooders to 180. Now we're back down to less than half of that, and I know that makes a lot of people unhappy, but I think their foot is going to slip off the spring again, and it's going to shoot up. And that I can't give you an exact time, but it's going to be sometime within the next few short months. And they're playing a dangerous game. We have patents, we have results, we have transparency, we are talking to some of the biggest companies in the world, and not only that, we're also talking to companies on potential financing, and down the road, I don't want to do a financing at this moment, and potential joint ventures. So any one of those things happens, it's going to be a surprise to the predators. And, it doesn't matter what the price is, they're going to be the losers at the end of the day. And, you got to remember the predators are not there to help the market. Predators are there to, as the saying goes, to eat your lunch. And, they're only happy when the company goes, to zero. And, they pick up all the money. They want to be the only ones to make money on a project. They want to kill jobs. They want to kill companies. That's their goal in life is to make money, and killing jobs is part of that, and killing investors' investments is another part of that. But now they're picking on a company that has fantastic results out. We're very close to nearing the end of all our programs, and then I think the game will be on. But does it piss me off? Oh yeah, it pisses me off. I mean, to see this happen day after day after day. Save Canadian Mining is not exactly making any traction. And it doesn't seem like the regulatory authorities are interested in helping out the investors. They're only interested in helping out predator traders. And it's just the Wild West for them. They just come out with both guns blazing and bullets flying anywhere. And they hurt investors. They tried it at 2 cents. They got nailed. And they tried it at 20 cents. And they got heavily nailed. And, so it's not a one-sided street. If you know what the game is, you can always work your way around to having another spectacular rise in the price of stock. And I certainly know what the game is. I've been talking about predators for, I guess it's, since 2013. And, and now there's a lot more people talking about it. It's become front and center with the Robin Hood traders beating up on predators. So, that doesn't make me happy, but, other things do. We've got, lots of work in progress, not just necessarily on our process or the manganese project. We're talking to people that can write a check tomorrow, and but that's up to them. And we've been actually talking to some of these groups for 3 years. So, but now we're close to being able to deliver other things that they want to see, and we'll see what happens. So it's an interesting game. It certainly doesn't make you feel good when your net worth goes down $500,000 a day sort of thing, and like in my case. So I want to see the turnaround, and I'm working towards getting that turnaround happening. And I want to assure my shareholders that we've beat them over the head twice. So I'm going for 3 times lucky. Three times is a charm, they say. So we'll see what happens on that. It also brings out other predators that want to get the company for nothing, and they think that they can just take the glory and walk. I'm here to tell them that that's not the case. You just can't walk in and fill somebody else's shoes and expect that everything is going to work out smoothly for you. I've got a loyal group of shareholders, and a lot of them been in since 2 cents, and a lot of them since the 20 cent range. Some of them averaged up, going up, and so they're not quite as happy as they should be. But there's still lots of millionaires out there from the AMY stock, and that makes me happy, because that's what you're here for. You're here to build a company and make the shareholders rich, and that's exactly been my goal in all my companies. A lot of people don't realize that over the last 40 years, I've had maybe 50, 60, 10 baggers in the stock. A lot of people have made money. That's why a lot of people are still with me. And, and I hope to do that again. We're still up 6 times, and 6 times is not exactly a loss for a lot of the shareholders, but the new shareholders, yes, I can understand their pain. But, you just have to look at the reason. The reason you should have invested is not because of the volume and the stock going up. You should have invested because you liked the project, that you saw what the management saw, and so you can have an easy night's sleep. And it's kind of working out that way. I've included some links to other articles out there. And I'm looking again at something we included last year. There's something like 600 gigawatts planned for the European area. That's huge. And, our deal with the Italian company is would represent, 10% of that 600,000. So we're still talking back and forth, and, they're designing their plant. So I don't want to let the cat out of the bag, but the thing is that the plant is, looking at recycling because of the laws that are coming into the European Union on toughening up the recycling to make it compatible to, building EV cars where you have very little pollution. And we're trying to deliver a project that is pollution-free, and we're not talking about proprietary stuff, which may or may not be. And we have basically got patents on that. When you start counting up the patents, and by the end of this year, I'd hope that we can count up to, something like 13 patents around the world, and including the manganese, which is our big start. And, we've got the manganese posed a huge problem, and with consultation with Cometco, we were able to bring that problem around to a sustainable situation, but you still need the price of manganese to go up, and that's been slow happening because the Chinese got a big foot in that puddle. And so they overbuild, as they always do. They overbuild until they crush the price, and then they have to work through the stockpiles that they have. So that is coming, and so we're a company with 2 projects. Regardless of whether we do the spin out or not, we plan on trying to get the project going up on our copper gold project. We mentioned we had the 43101 resource, but we've also now applied for all the permits, and so it's we got a lot of stuff in the oven, and certainly the price of gold and silver has been up and down, mostly down in the last couple of months, and that is something you have to contend with. But $1,700 an ounce is still a damn good price out there, and copper is still over $4. I mean, you see the stockpiles are building. That's a trick of the short traders. Is all of a sudden you see tons, hundreds of thousands of tons appear in the stockpile out of the blue. And, to me that is paper, and it's a manipulation of the price of copper. But it seems like the price of copper has been holding up well. I mean, the stockpile has more than doubled in the last little while, up 13,000 tons again today. When I used to write my newsletter, which had a lot of followers, I used to keep track of stockpile prices. Was one of the things. Stockpiles were one of the things I kept in the radar, and it was a pretty successful letter until 2011, and I pretty much shut the door. Fundamentals weren't working anymore, and I did leave a list of companies that should be bought. And I think that 80% of them went up to be 10 baggers or plus, and they went back down. Now they're back up 10 baggers. These are producers. And so it's, am I happy? Well, I'm not happy when I look at the price of the stock, but am I happy about other things? Yes, I am happy, even though that the market through the predators is not recognizing our advancements. The fact of the matter is I am. And I see a big future for the company, and I would like to say to everybody, relax. I don't know what financial position you're in with holding the stock for a few more months, but this is probably not the area to be exiting. And just wait. There's going to be more news coming. And one of these days that news will happen. I mean, we didn't see the MOU we did with the Italian company do much for the stock. We didn't see the fact that we've pretty much been granted the Korean patent. And no other company out there can say that. They've got patents. You see them apply for patents. You see they got patents, but they're all on black mass. And, ours is on the metallurgy, the black mass. We can get, we're going to do scraps, so that's readily available. That'll be available daily. And, we'd hope to corner a lot of that market at some point and keep our business going. The people that are buying on dips or whatever, I would wait till the end of the day. You'll see a lot of stock offered. You'll see the stock going down, and that is the predators shorting. Buy that stock because, that's a tool that they use, and that tool can be used against them. And so I would recommend that if you are looking at purchasing shares, look towards the end of the day when they play their games the most, and buy those orders that the predators are offering, and get a better price.
Larry, where are you traded, and where can people get more information about American Manganese?
We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded on the QB US Exchange under the symbol AMYZF, and we're traded in Frankfurt under the symbol 2AM. You can find out any information that you want at our website, AmericanManganeseInc.com. That is a good place to do your due diligence. If you want to contact the company directly, phone 778-574-4444, or you can email me at LREAUGH@AMYMN.com.
Larry, thank you very much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on April 9th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.